Good afternoon, all the GST lovers, to this webinar series. It's a wonderful series started by the IDC and GST Committee of ICI. And in this webinar, we always discuss the burning issues. And you all know this webinar is on ITC, Input Tax Credit. It's a core of GST. It's a subject where everybody has some or other issues, and to tackle and to give all the details regarding the issues in ITC, we have a very renowned and a very uh, best faculty in this area of GST ITC, that is Rishabh Mishra from Lucknow. He is also secretary of the branch Lucknow, and in spite of all his administrative duties, he loves to practice in GST and always happy to share knowledge in GST. In absentia, Chairman Rajendra Kumar sir, who is busy in his other schedule, he is not available today. But under his leadership, GST and IDT committee is working hand to hand with the vision of Government of India. As you all know, the GST is a very evolving subject, completed 8 years. And when we talk of 8 years, तो ये एक छोटा बच्चा है अभी. अब ये थोड़ा 8 years के बाद में बड़ा होगा, तो इसके इश्यूज भी न्यू और बड़े इश्यूज आपको मिलेंगे. सो all we chartered accountants who are practicing in GST needs to upgrade our knowledge and have to go into litigation practice. Friends, we have launched a GST litigation course of 6 days. I will request all the members to join that course because the GST tribunal is going to be a reality in few of the months coming forward, and across India the benches will come out. So the practice of GST will move forward with the GST tribunals going forward. So please be ready for the GST litigation courses and always have a look on the recent books published by GST and IDT committee. We have just released a book on related to issues and the updates of the disputes litigations. Then we are working on revised book on TCS. We have already upgraded our background material, which are all available on GST and IDT committee website as well as the CDS portal. So friends, please send your suggestions and your queries to us. So our speaker today will take time wherever possible at the end of the session to answer your queries, and your suggestions will be noted by our team, the able team which is led by Preet Kaur, and our tech team, and also Secretary Smita Mishra and Ajay, all are there. So we compile your suggestion and we represent to the government on the different aspects of GST. So, with this brief introduction of our speaker and my opening remarks, being a vice chairman of this committee, I welcome you all, the participants, and I hand over the mic to Rishabh ji. Over to you, Rishabh bhai.
A very good evening to respected Chairman IDT Committee, CA Rajen Kumar sir, respected Vice Chairman sir, CA Umesh Sharma sir, the entire team of Indirect Tax Committee, Smita Madam, Ajay ji, Impreet ji, and all other team behind this webinar. Firstly, I would like to express my gratitude to the entire IDT team for giving me this opportunity to come here and express my views on the current issues in input tax credit. Members, we have a long history of litigation since the inception of GST input tax credit has been one area in which I don't think any CA firm in India has not received any issue or notice. And the issues are so common and pervasive that as a practitioner, we cannot just wipe them out, and we have to upgrade ourselves. We need to have an understanding of the issues and how to correctly address these issues. A lot of litigation has traveled to the courts. A lot of ITC litigation has arisen on account of divergent views of the advanced rulings we have. The appellate authorities of advanced rulings have made our job more cumbersome and complex. In today's webinar, I'll try to highlight the recent issues which we face in our day to day practice, and we'll try to dwell upon areas where there is most of the litigation concentrated to. We need to have a, as I suppose, we already have a basic understanding of the legal provisions. The ITC provisions under the GST law principally travels from section 16 to section 21, and we have rule 36 to rule 45 covering the entire gamut of the provisions under the law. Input tax credit has been defined under section 263 of the Act, which means the input tax credit means the credit of input tax. Now, what is input tax has been further defined in 262 of the Act. We have our definition in front of us, but just to put it in a simple way, input tax means a tax charged on any supply of goods and services. So it is not the tax which is payable on any supply of goods and services. Rather, the definition tells us that it is a tax charged on any supply. So there has to be a charge on a supply, and that charge has to be created by someone, whether the person is a supplier or a recipient in case of reverse charge supplies. So, where any tax or any supply has not suffered this charge, there cannot be a question of input tax. So, the question of input tax arises only when there is a charge of tax, and let us emphasize that the words used in the statute should not be intermingled with, and the difference between the charge of tax and the liability to pay tax is evident on all aspects. Taking it forward, we have seen to what input tax credit actually relates to. It relates to the CGST, the SGST, the IGST, the UTGST, the taxes that we pay on reverse charge basis, and the tax which we have paid on import of goods. So to put this definition in a simpler way, input tax means all the taxes charged under the CGST, State GST, UTGST, and IGST Act, along with the tax which has been charged by the recipient on reverse charge supplies and the tax charged on goods imported into India. So we have dealt with the basic definition of what constitutes input tax credit. We have already discussed the ambit of our statute covering section 16 to 21 and rule 36 to 45. We have different provisions related to input tax credit. Section 16 talks of the eligibility and conditions of claiming the credit. Section 17 talks of the apportionment of credit and blocked credit. And there are certain special circumstances where we are required to deal with the ITC issues, which is being dealt with Section 18 of the Act. Fundamentally, we all may be aware that Section 155 of the Act stipulates that the person who is claiming the credit, he is entitled to establish whether he is eligible to take the credit and he is satisfying all the conditions to take the credit. So the onus or the burden to prove that the credit is bona fide is on the recipient who is claiming the credit. On the similar lines, Section 16(1) stipulates that a registered person can claim the credit, not a taxable person. So anyone who is not registered under the GST law cannot take the credit. Only a registered person can take a credit. But availing the credit or claiming the credit is not a blanket exercise. Claiming the credit is not the absolute right, we can say. It is a conditional right. The person claiming the credit has to fulfill those conditions, has to abide by the stipulations of law at the time of claiming the credit. We cannot say that under the framework of the GST law, input tax credit is our fundamental right. That cases have been already gone to the courts, and various courts under the GST regime have held that the scheme of law and the scheme of GST law has clearly stipulated that credit, claiming of credit, has to be complied with conditions and restrictions which are already given in the law, and the person claiming the credit must adhere to those conditions. Another important aspect that 16(1) stipulates is the intention to use the goods or services in the course or furtherance of business. So, mere intention to use it in his, her, or its business makes the recipient eligible to take the credit. So, the goods which are actually used or the services which are actually used in the course and furtherance of business are definitely qualifies for availment of ITC. But even if a registered person intends to use it, so that intention matters, and that very intention qualifies a registered person to take the credit. The third aspect A credit is only a credit when it is credited to the electronic credit ledger. If the credit is not credited to electronic credit ledger, that is not a input tax credit in the eyes of GST law. So this is also a precondition of 16(1) that there has to be a hit on the credit ledger. If there is no hit on the credit ledger, that we cannot say that we have claimed the credit or availed the credit. So these three are the basic conditions and stipulations which we need to keep in mind while advising, while rendering our services and advising our clients to bear and comply with. We are going through the basic provisions of law. I won't take much time since I already understand that we are already aware of the basic scheme of law. So we'll just pass through this in a shorter span of time and directly come to the issues. But having a brief background is important to discuss the issues. We know the basic conditions for claiming the credit have to be complied with. Basic condition includes that we must possess a tax invoice, the goods or services must be received. The 16(2)(c) says tax charged has been paid to the government and must be paid to the government. 16(2)(c) is also linked with Section 41 of the Act. Section 41 post amendment stipulates that once you have claimed the credit and you find that your supplier has not paid the taxes in its 3B returns, then you are liable to reverse that credit. And once you reverse the credit, you reverse it along with interest, then you can reclaim it when it comes to your knowledge that the due tax has been paid. So 16(2)(c) has to be read with the specific stipulation of Section 41. Then another condition that is required to be fulfilled is the supplier has furnished its GSTR1 and the credit is reflecting in the GSTR2B of the recipient. The last condition which is necessary is the recipient must have filed its 3B return under Section 39 of the Act. Section 17(3), 16(3), there is no change that where a registered person has claimed the credit, he must not include the value of credit in the cost while capitalizing the asset. If at all it is found that the capitalization of an asset is done by including the value of taxes and the depreciation has been charged, then credit shall not be allowed in those circumstances. So 16(3), we do not find any change since the inception of the GST law. 16(3) remains the same. There has been a change and disputes litigations on the issue of timeline of claiming the credit. And there comes into picture Section 16(4). Earlier, prior to financial year 21-22, there was a stipulation that for any financial year or for any tax period falling within a financial year, a registered person can claim the credit by the due date of 30th of GSTR 3B for September or furnishing of the annual return, whichever is earlier. But since financial year 21-22, there has been an amendment to extend the timeline by 40 days, and now the due date for claiming the credit for any financial year stands 30th November. The same has also been clarified that this amendment has been done in the law with effect from 1st October 2022. And further, there was a press release of 4th October 2022 that this amendment is effective from financial year 21-22 and onwards. So we'll deal with the issues relating to 16.4 and the basic primary conditions in some time from now. Rule 36.4. A lot of legal debate has been undertaken with regard to the validity of Rule 36.4, the enabling section under which this rule was notified, the implications. Many SSEs have approached various courts to challenge the validity of this rule. The department has taken a stand. We have got n number of notices where the validity of this rule has been challenged. And we can see that there is a history of litigation surrounding the legal provisions as they appear and the rights of the taxpayer to claim the credit. So we have seen that Rule 36.4 has had stipulated the extent of credit which an assessee can claim which is not appearing GSTR 2A. The rule was notified with effect from 9th October 2019, and this rule stipulates that a provisional credit cannot exceed the prescribed percentage written in the rule, defined in the rule. That prescribed percentage was 20% effective from 9th October 2019 till 31/12/2019. It was further, the variance or the deviation was further reduced to 10% and then 5%. Before the implementation of this rule or before the notification came for enabling this rule, the entire credit which was not appearing in 2A was considered as provisional credit, and the assessees were eligible to claim the credit on self-assessment basis in their GSTR 3B returns. After the insertion of this rule, the provisional ITC was restricted to the extent of prescribed percentage to the total eligible ITC, which had to be complied with under the provisions of this rule. Another important aspect, and we see which surround is Rule 37A. The same was notified with effect from 26/12/2022, and it requires reversal of ITC in case of non-payment of tax by the supplier, where the supplier has not filed its GSTR 3B returns by the due date of September following next year. The supplier has filed it within the time, the assessee can claim the credit. Where they have not filed within the prescribed time, the registered recipient is required to reverse the credit by 30th November in its 3B return and pay the interest. Once he finds that supplier that his supplier has filed GSTR 3B return, they are permitted to reclaim the credit. The, this definitely creates some working capital issues for the recipient, the compliance, and also it incurs interest cost also. So we need to be vigilant, and therefore many assessees had started the practice of withholding the amount of ITC till it is not paid. The component of tax was withheld till the supplier is not filing its GSTR 1 returns and paying the taxes in 3B returns. So that was a practical scenario which was implemented by many assessees to ensure that they are not faced with any working capital issues and they are not faced with any interest costs or interest burden. With this brief introduction, we are now coming down to the critical issues which we face on a day to day litigation. And we'll also try to delve in what are the possible solutions and remedies, what are the suggestive replies, suggestive course of action that can be taken by us as professionals when we face certain issues and we deal with notices of our clients. Firstly, we are moving ahead. In case of issues where the dealer registration gets cancelled, we all must have seen various notices coming in where the registrations of our suppliers of gets cancelled on a retrospective basis due to non-filing of return, not doing any compliances, not taking proper credits, not responding to the information sought by the department, and there can be other reasons. So in these cases, we find that the supplier's GST registration is cancelled by the department, and our clients who are recipients of goods and services get notices that since the supplier registration has been cancelled, our clients or the registered recipients are required to pay the taxes, and a demand is created in all such cases. Now we have a very classic case of LGW Industries. It is a Calcutta High Court judgment which has discussed the issue in detail, and before relying on any judgment, we must go through and we must discuss the implications, the reasoning given by the courts, and the reasoning given by the courts serves as a guiding light in many cases. In this case, the High Court of Calcutta, the Honorable High Court of Calcutta, has given various reasons of why a taxpayer whose registration has been cancelled retrospectively by the department, the recipients should not suffer. Now, let us discuss what the court actually reasoned while pronouncing the order. The court said that ITC cannot be denied on the ground of suo motu cancellation of registration. Disallowances of input tax credit on the ground that the purchases made by the petitioners are from non existing suppliers and the bank accounts opened by those are on the basis of fake document, and that the petitioners have not verified the genuineness and identity of the suppliers before entering into transaction with those suppliers. Respondent, who is the department, the court directed that case must be considered afresh. But once the case is being considered afresh, what has to be exactly seen? What the exact requirement that came up is the genuineness of transaction. Whether the supply was genuine, the transaction was genuine. The transaction was accompanied by invoice or e-bill. Whether the payments were made, whether the goods were actually moved. Are there any substantial evidences for like toll receipts, consignment notes, undertakings and declarations from the transporters that are there to substantiate and establish that the transactions were realistic, the transactions and the supply was not faked, the payments were made through genuine banking channels, and once the transaction is established to be genuine merely because the supplier's registration has been cancelled does not offer the revenue to disallow the credit of the recipient. With this, we can have a brief understanding of how the issues related to the cancellation of registration are being viewed by the courts, and Calcutta High Court has given a very detailed reasoning as to what all has to be seen and what all has to be adhered to in order to make the recipient eligible for claiming the credit. Another case that we counter on a day to day routine practice is we receive many notices in which there is an allegation that your dealer is non genuine. So, what to do where we receive notices or there is an issue and there has been an allegation from the revenue side that the person from whom you have received the goods is non genuine, means he is a fake dealer. There is a classic case of D.Y. Bethel, Madras High Court, where the High Court laid down few principles and questioned the respondent of the revenue that before calling anybody a fake supplier or a non existent supplier, have you gone through the facts of the case? Have you gone to find out who was the supplier? Was the transaction actually genuine or did not take place? And what all are the reasons which have led to a conclusion that the supplier is non existent. The court had its observation that the revenue must find out whether the tax has actually been paid to the government or not. The department in this case also proceeded for the recovery action under Section 79. The court said that it is the liability of the supplier to pay tax to the government. In the case of this indirect tax regime, the supplier acts as an agent of the government. And where you are disallowing any credit and eligible credit of the recipient, you must also vouch for the integrity and genuinity of the supplier. And the court directed the department that first, the recovery action must be initiated against the supplier and not the recipient should be demanded tax. So, in this case, wherever any demand or any notice is coming to the recipient, the court directed that first try to recover the taxes from the supplier. If at all you are unable to draw the taxes from the supplier, then you can think of coming to the recipient, but not before that. The court also directed that the person who has supplied the goods should be examined, and once the seller has collected the taxes from the recipient, it is the omission on the part of the seller, and strict action should be taken against the seller and not the action should not be initiated against the recipient. So all these things we can draw down, and this reasoning of the courts can help us prepare our cases in a better way to confront with the issues raised and to take a legal stand in these matters. The third issue which we normally face is the notices and demands on account of mismatches of credit. I think, to my understanding, this is the most common issue that is coming up to us as practitioners. And in any notice, there is at least minimum one para which is dedicated to mismatches of 2A and 3B. I'm sure that we must all be dealing with this in all parts of our country. And some cases we got the relief, in some cases we have not got the relief, and we have also got two circulars from the department, circular 183 and 193. So the lower authorities insist us to comply with circular 183 and 193 for their respective periods. But apart from the compliance from the circular 183, we can also rely on the judgment of Bharat Aluminium Company Limited. It is a issue taken up by the Chhattisgarh High Court, and in which the department proceeded with the recovery order in case of mismatch of ITC between GSTR 3B and GSTR 2A. The Chhattisgarh High Court examined the matter and directed the revenue not to take any coercive steps or not to initiate and proceed with the recovery action till you give an opportunity to the petitioner for submission of their reply, and the grounds taken by the petitioner involves a better consideration, and this is not a fit case to initiate the recovery. It is only a mismatch, and the petitioner has valid reasons to defend its case. Coming to another issue which we regularly face in dealing with the ITC matters pertains to Rule 86A. Rule 86A talks of blocking the credit which is available in the electronic credit ledger. Credit available in the electronic credit ledger, if that is fraudulent or that is ineligible, the officer AC and above has the power to block the credit, not more than a period of 1 year. But the action of blocking the credit, whether it is right or not, and what principles are to be followed, has been discussed in the matter of SS Industries. It is not that in every case the blocking is permitted under law. There has to be reason to believe. If there are no reason to believe, you cannot block the credit. To have a reason to believe, relevant material should be on record. And once we have a relevant material on record, we need to write, the concerned officer need to write down the reasons before blocking the credit. It should not be on the whims of and fancies of the officer, and should be strictly in accordance with the principles laid down by the Honorable Gujarat High Court. So, any cases on a daily basis, we deal with the issues for our clients, and client comes up and says that my credit has been blocked from the electronic credit ledger. What is the remedy? So, we can write a letter to the concerned officer asking him what are the reasons which have been relied by the revenue to block the credit. Blocking the credit is not a proper action if there is no credible material on the records. And the department has to have cogent material, verified transaction, and verified source to pass any specific order for blocking the credit. So, all the reasons can be raised before the authorities, and accordingly, we can proceed to unblock the credit for our clients. Also, we also need to question the department, the authority, and the relevant document against which such action has been taken on the recipient. Vendor payment within 180 days, Rule 37 and the 16.2 proviso stipulates a condition that once a recipient has taken the credit against an invoice or a debit note, payment of that invoice means the taxable value along with tax has to be paid within 180 days to the supplier. If the same is not paid, the recipient who has claimed the credit is required to reverse the proportionate ITC. If the entire invoice is not paid, full ITC is required to be reversed. And reversal has to be done from the date of claiming the credit and not for the period after the 180 days have expired. So, where we are bound to reverse the credit since inception or the date from which we have claimed the credit, there arises a substantial interest liability under Section 50. And we have been receiving number of cases where demand is being created against the taxpayers who are not able to comply with the provisions of Rule 37 or provisions of proviso to Section 16.2 of the Act. Now, what if we receive a demand on account of non-compliance of Rule 37? Rule 37 says that it is applicable only when there is a failure to pay. Now, what is failure to pay? Does failure to pay is the inability to pay, or we have not paid the supplier because it was our contractual terms? So, what exactly the law intends when it prescribes the terms fails to pay? We can refer to the Black Law Dictionary, which says fails to pay means a failure. Failure means you are incapable to pay. But we have certain cases in the erstwhile regime which says that failure to pay is a condition of payment, and any stipulation beyond 180 days is a condition to contract. So we have to be careful while drafting our contracts. There is a specific stipulation in the GST law, and where there is a specific stipulation in the law, any contract cannot override the law. So a written contract must have to be in consonance with the legal provisions. So the issues of failure to pay, we can take certain grounds, we can take a plea before the courts that such failure actually means the incapability to pay. But in our case, there is no incapability, and it is only the condition to the contract that we are complying. But there has been few judgments of the courts where relief has also not been granted. So we must draft our contracts accordingly, keeping in view what actually prescribes the law. With this background, what one thing comes to our mind as to what is the remedies, what are the pleas, and what are the grounds that one can take when we receive ITC related notices or we receive ITC related litigation. What we can do or what we can offer as our submission to the adjudicating authority or the appellate authority. So, for that, we have compiled a suggestive grounds which can be taken while drafting reply to notices, while preparing the grounds of appeal, while arguing the cases before the adjudicating authority or the appellate authority. So let us discuss this one by one. These grounds are on the basis of settled legal principles that have been laid down by the courts in the erstwhile regime and in the GST regime. Many grounds have been reiterated by the court time and again in different judgments. So, how we proceed? We must proceed with checking the section in which the notice has been issued. Notice for mismatch cannot be issued under Section 74. Section 74 requires establishment of fraud, misstatement, and the like, where the transactions are only on account of mismatch of ITC or the demand is on account of mismatch of ITC, extended period cannot be invoked. And once extended period cannot be invoked, there is no reason why 74 is coming into play. So, all the issues, if you find any demand under show cause notice issued under section 74, we must legally challenge it as it is arising merely out of the data on the GST portal, and it is not something where tax has been evaded or a fraud has been committed or any facts have been misstated. Then, any demand on account of ITC mismatches have to be supported by reasons. Normally, in the state notices particularly, what I have observed that there is no or minimal concept of enclosing relied upon documents, which we normally call RUDs. So when there are no RUDs, at many point of time we are not aware from where a particular figure or whatever the demand has come up, and we have to have copy of relied upon documents. Normally, in the show cause notices or demands issued by central GST authorities, we have proper backup documentation or RUDs, which can be examined by us while preparing the reply. So, if there are no RUDs against any demand, we can challenge the show cause notices that merely quoting a figure of mismatch or merely quoting a fact without enclosing the relevant RUD, the demand show cause notice is itself not sustainable. So, such grounds, such issues can be taken where we are dealing with authorities and we are not having the underlying data to comprehend from where a value or particular value in a notice has been arrived at. And We must document our initial objections at the very stage of filing our defense reply. So these are the fundamental principles that we need to adhere to while responding to notices and responding and preparing our replies. Show cause notices must also state that in which manner the conditions of section 16 have not been complied with the recipient or your client. Where the conditions of section 16 have not been fulfilled, there ought to be a detailed reasoning for this. So, how the conditions are not fulfilled, what on the basis of what documents it has been found out that the conditions of section 16 are not complied with, has to be taken into consideration while replying to the notice. Where the supplier was holding a valid GST registration, the registration has been granted by the department, ensuring that the supplier complies with the provisions of law is not in the hands of the recipient, and there is no mechanism to check whether the supplier has paid its taxes, filed its return, reported our invoices. So, in the absence of any such specific mechanism for the recipients, there cannot be a demand based on fake grounds. Next, we must also state the length of association of the supplier. If we are having a KYC, the time duration between which the business have been continuously carried on between the recipient and the supplier matters. And we must specifically state that with this supplier we are dealing with past 10 years or 20 years. And we are well aware that there cannot be a reason that he is non-compliant. We have the KYC, we have his supplier profile, he has been regular in filing the returns. So all these things can be mentioned in our defense reply or the grounds about the supplier where such issues are arising. Further, the goods that or services that have been received, where are they used? If they are used in our business, we are eligible to claim the credit. We have used it and we can correlate it that by using it, we have rendered these services that again establishes that the supply is bona fide and genuine. So, merely non complying with a procedural requirement or not filing the return correctly does not disentitle the recipient not to claim the credit. Payments. Once the payments are made through proper banking channels, payments are acknowledged, accounted for. That is a substantial proof that the supplies are bona fide and genuine. Accounting of the purchases in our books of accounts, keeping the proper records, the transportation records, the e-way bill records, the toll receipts, if at all possible, whether the transportation of goods have taken place through trucks and vehicles having the RFID devices. All these things are required to ensure that our supplies are genuine. and accordingly we can respond to the demands raised in this regard. We can also mention that supplier is an agent of the government. Once we pay to the supplier, and in the indirect tax regime as GST, it is the supplier who collects the tax on behalf of the government and then remits it to the government account. So once we have made the payment to the agent of the government, we have sufficiently complied with the condition that the due tax have been remitted. If at all the agent has not remitted it further to the government, action must be taken against the agent and not the recipient. Also, we find that once the ITC is disallowed, the tax liability, the impact of the disallowance is that the tax liability gets shifted from the recipient, from the supplier to the buyer. It also causes double taxation on the buyer, as once we have already paid the supplier the requisite tax, we are again being demanded, and when we have to pay the tax, it will be a double jeopardy on the line of the recipient. Further, there is also a possibility of unjust enrichment to the government. When the revenue demands taxes from both the ends, from the supplier and the recipient, there is a possibility that the government gets unjustly rich. And therefore, we must appropriately counter the allegations of the show cause notice and the demand orders on these grounds. Further, we can also state that a genuine purchaser and a fraudulent purchaser cannot be treated at par. A genuine purchaser has to be differentiated with one who is doing or carrying business fraudulently. So, where any demand is being raised again on the recipient, it violates the very basic principles of law that a good person and a criminal cannot be equated. There has to be some difference. And when one demand is raised, it is just like treating a good person and a criminal alike. So there has to be some grounds where these issues need to be addressed and have to be looked on from a larger perspective and not merely from the perspective of recovering the tax revenue. Also, we have discussed that input tax credit is the substantive right of the recipient. Procedural lapse cannot override the substantive rights. Also, we must find out in question that whether any action has been taken against the supplier or not. So, at a very basic level, once we are questioning the authorities that, okay, you are giving me notices for demands and recoveries, but have you examined the supplier? So, naturally, we get an answer that supplier is not of my jurisdiction. And since the supplier is not in my jurisdiction, I cannot initiate any action against the supplier. That is a standard answer. But to this, we must file a counter reply. Once we file the counter reply, that if the supplier is not in the jurisdiction of the concerned officer or the revenue officer, he must write a letter to his jurisdictional officer to find out the facts. And there should be an internal mechanism of communication between various officers to let each other know the status of their suppliers. GST, we all know, is an integrated tax. Constitutionally, the powers of central government and state government to levy tax on goods and services have been equated. So, when the powers to levy tax on goods and services have been equated, why there is an absence of mechanism to cross check the status of supplier and a mechanism to communicate between all India revenue officers to ensure that the suppliers in the other jurisdiction also faces the consequences if we are not complying with the provisions of law. So there has to be and there should be some mechanism that central and state level officers, state to state level, state to UT officers, central to UT officers on a pan India basis should be able to communicate and find out if the supplier of their jurisdiction is proper or not, or is making regular GST compliances or not, and not merely the recipient should pay the price all the times. So these are the issues, these are the grounds which can be relied upon while we are answering the notices or we are drafting the replies to various issues related to input tax credit. Another very important aspect at the lower level, at the adjudication level and the first appeal level, we generally see that the officers insist on compliance with Circular 183. But compliance with Circular 183 is not foolproof as there are certain limitations to it. Circular 183 requires a certificate from the supplier or his or her chartered accountant. But what if the supplier and the recipient are no longer in business? So there are practical challenges in the compliance of Circular 183, which has not been addressed by the department or the ministry till now, even after multiple representations from all the corners. So Circular 183 prescribes for reconciling the mismatch of 1718 and 1819. There may be various reasons of mismatch, but the primary conditions have to be complied with while we are complying with the Circular 183. That is, we must possess invoice, goods should and services should have been received, and payment has to be done to the supplier. If the primary conditions are satisfied, then we can obviously seek a chartered accountant or a cost accountant certificate where the supply is over 5 lakh rupees and where the supplier has supplied for a value less than 5 lakh rupees, the supply vendor certificate or the supplier certificate will suffice. But there are certain issues that what if the supplier and the recipient are not in the talking terms or they are not in business, they are not responding to the calls and mails, they are not providing the certificate. So these issues are very practical issues, and not many of the recipients face these issues, and they face challenges in compliance with the requirement of the circular. So again, what we can do in this case, while preparing the reply, while drafting the reply, we must enclose all the communication which we have done with the suppliers to ensure the compliance of this certificate. All the emails, all the post, all the courier letters, everything which we have done to communicate, establish the communication and seek the certificate. That has to be enclosed along with our, if we are replying to a notice, we must enclose it along as an annexure to this reply to our notice, or if we are at the appellate stage, we must ensure that these documents are forming part of our grounds of appeal also. And once they form part of the grounds of appeal, we have a good case to contest that where we are not having any response from the supplier, we must be not forced to comply with Circular 188, 183, and relief should be given on the merits of the case and other underlying documents such as invoices, ledger accounts, payment receipts, payment details, transportation good, transportation receipts, and the underlying documents. So we need to have this in mind while preparing our replies. Next, in line with Circular 183, we also have Circular 193. So Circular 183 covers the period 1st July 17 to 8th October 2019. And Circular 193 covers the period 9th October 19, the date from which Rule 36(4) was notified, to 31/12/2021. So, what additionally Circular 193 states? Circular 193 additionally states that you prepare a reconciliation, whatever mismatch is there, and kindly check if the mismatch does not cross the specified limit of Rule 36(4). The specified limit of Rule 36(4) was 20%, 10%, and 5%. So, within that limit, whatever mismatch is there, produce certificate as per 183. So, Circular 193 does not talk of the entire mismatch which is there in between GSTR 2A and 3B. It talks only of the extent of mismatch which is in the permissible limit of 36(4). And for that level of mismatch which is permissible under 36(4), we can produce a certificate as defined in Circular 183. So again, the compliance and the applicability of Circular 193 has to be clear from our side. The issues of ITC are not limited to only the mismatches, only dealing with the non-existent or fake suppliers or suppliers whose registration have been cancelled. but the issues far stretch to include legal matters and legal interpretation as well. One such case of safari retreats is a classic case of how the issues at a legal platform should be dealt with. This case talks about the applicability of Section 17.5D, the restriction of in claiming the credit as defined in Section 17.5D, and there is a long judgment by the Honorable Supreme Court which has covered various aspects to what a plant and machinery is and where the credit can be claimed in case of malls, cinema halls, commercial complexes, and the like, and where credit cannot be claimed. What test is important, how the law has been drafted, what are the anomalies in the drafting, and how the government has made retrospective amendments to the explanation to section 17.5, and what were the submissions from the government side. Briefly, why are we taking this case today? What is the intent behind taking this issue to discussion? The intent behind is to discuss whether the ITC pertaining to construction of mall is eligible after this judgment and after the retrospective amendment which we saw in Finance Act 2025. We also need to discuss that instead of giving a single contract, can the contract be broken down into a separate contracts of goods and separate contract of services? And whether we should actually discuss the implications of doing it and not doing it. The 55th Council has overturned the judgment to correct the errors in drafting of the law. The phrase plant or machinery has now been corrected retrospectively to state that it is plant and machinery and not plant or machinery. This amendment has aligned Section 17.5D with the explanation. So, what if we are getting notices for whether the credit is eligible or not, how to structure our contracts, how to plan, and whether to claim this credit or not at all. Post this judgment, one thing which has been made clear by the retrospective amendment is the government intends to allow credit on plant and machinery. So, if any structure is a plant and machinery, whether it is fitted in a mall or a cinema house or a factory, it is irrelevant. If that particular installation is plant, or we can say if that is a machinery which is being used for production, the credit is eligible. There is no doubt. The only issue that comes up when a particular structure qualifies as a building or an immovable property. So, whenever a structure qualifies as a building, there is a clear restriction under section 17.5 that the credit should not be taken. Section 17.5D, anything which is used to construct an immovable property, anything which is used in the construction of immovable property on his own account, credit is not eligible. Any goods and services which are taken to construct an immovable property. So, keeping this, the concept of own account has also to be deliberated. Own account means normally for anything which is being done and anything which is being constructed, which is for the personal use, or it is being used for his self consumption. So there has to be a differentiation between what is being used for own consumption or self consumption and what is being used in the business. So that difference explains section the restriction of ITC prescribed in section 17.5D. The court also discussed about the functionality test. Now, what is functionality test? So once we ascertain that a structure is plant and machinery and not building or an immovable property, the principles laid down by the Supreme Court in Safari retreats can still be referred and relevant. How to determine if a structure is a plant? So there is certain criterias which can be tested to identify that a particular structure qualifies as a plant and not as a building. The first is its movability, its operational and functional capabilities and utility, how it is being used, what is the use, how mobile it is. That determines whether a structure is a plant or it is not a plant. How it is integrated with the immovable property, the extent of integration. Any structure, it has been led by Supreme Court in judgments of the erstwhile regime that the manner of annexation and the object of annexation is relevant. The manner of annexation and the object of annexation determines whether anything is a immovable property or not. Anything which has the effect of damaging the structure when it is being taken out dismantled or separated from a particular structure qualifies as immovable property. And anything which is not so integrated in the civil structure so as not to cause any damage, that qualifies as a plant. Further, physical and operational interdependence of goods is important to establish whether it is a plant or not. It should be indispensable for the business operations. If there is any specialized design and engineering required to prepare the structure, it can qualify as plant. And it should be more than a mere safeguard for your assets. So anything which is safeguarding the assets cannot be termed as a plant. A plant should have some or the other functional utility and operational utility. So these are the certain indicators which can help us to analyze whether our activity or our credit or our business is hit by the provisions of section 17(5)(d) or not. Coming to, we have been also seeing and reading many cases with respect to transactions involving fake invoices. There is a very important circular 171 which talks of how to deal with that. At many times, we have seen multiple penalties and show cause notice for the same offense. But this has been dealt with circular 171. And whenever we are dealing with any such matters or any fake invoicing matters, we need to have an understanding of the issues dealt with circular 171 so that the same can be incorporated in our defense replies. So this circular deals with three circumstances. The first circumstance is, and what this circular determines, it determines in what cases only penalty is applicable and in what other cases tax demand along with penalty is applicable. So the circular clarifies an approach as to under which situations and circumstances the department can levy a penalty, and it also clarifies under which situation and circumstances the department has to issue a show cause notice of demand along with penalty. So it deals with first situation, and let us discuss on a situation one. A issues an invoice to B without any underlying supply. When A issues an invoice, A does not supply any goods. Only there is a transfer of credit through a document which is called an invoice. What this circular tells us, in the absence of actual supply, no tax demands can be made from A. The person who have raised or issued a fake invoice is not liable to any tax demands. However, he is liable to penalty under section 122(1)(2) of the Act for committing an offense of issuing the invoice without actual supply of goods and services. So Where there is a fake supply transaction, there is only invoice being issued, there is no underlying supply from one person to the other. The supplier cannot be charged with a tax liability. The supplier has to be proceeded with only by levy of penalty under section 122. Second situation, where a supplier A issues an invoice to B and B claims the credit and issues another invoice to C with actual supply of goods or services and utilizes the credit which has been passed on to him from A. What will be the treatment? In this case, B shall be liable for demand and recovery under section 74 of the Act. So B will be charged with a demand of not only tax but also a demand of penalty under section 74. And there is a settled principle that a person cannot be made liable twice for a single offense. So, in this case, B is using the credit which is fake or which is without supply of any underlying goods, and he utilizes it against his actual and real supplies. So, where he utilizes the credit, it is that point where the demand and recovery provisions will be initiated and show cause notice under section 74 will be issued. In cases where there is only a pass through entry of ITC, no show cause notices will be issued under section 74. And show cause notice for penalty under section 122 will be levied. That is already given under the provisions of section 1775(13) of the Act. The third situation, where a person issues an invoice without any underlying supply and the person receiving the invoice also passes a credit to a third party without any actual underlying supply. So there are two stages, or there is a chain reaction of passing of fake ITC. So in this case, no demand and recovery of either ITC wrongly availed by B to C is required. And the entire channel of fake passing of ITC will suffer penalty under section 122(1) of 2 of the Act and 122(1)(7) of the Act for doing an offense of issuing invoices without any actual supply of goods or services, as also for taking or utilizing the credit without actual receipt of goods. So with circular 171, there has been a coming a clarity as to how the cases of passing of fake credit have to be dealt with, penalized, and where the demand has to be raised and where the demand is not required to be raised. Another important aspect in such cases is that the person who has retained the benefit of the transaction and at whose instance such transactions are conducted shall also be liable for penal actions. Person, if there are prosecution provisions under the section 132 of the Act, And above a certain threshold of 5 crores, even the prosecution proceedings can be initiated against those persons who abet those transactions and at whose instances these transactions take place. With this, I would like to open the forum for the questions from the members, and we need to deal with the queries of the members, please.
Thank you, sir, for wonderful session. You have questions in the question link, admin link I've shared with you.
In the question panel, madam,
Yes, sir.
in the chats, I could not see any questions now.
Let's take a break for a minute.
Okay, okay. So now we have some questions from the members, which we'll take one by one. The first question is whether we can avail ITC on construction and finishing of industrial plot to be used for renting, ITC on construction and finishing of industrial plot. In my view, this credit qualifies restriction under section 17(5)(d), and in my view, it cannot be taken basis the judgment of safari retreats and the consequential amendments in Finance Act 2025. The second question is hotel industry ITC. The question is not complete, I think. Can you please elaborate what exactly that is required? The other question, the proper officer observed genuinity of ITC is linked with the evidence of actual supply of goods, even though all other ingredients are present as per section 16(2). Please highlight any case pending before Supreme Court. The any actual ITC which is genuine and evidenced with actual supply of goods as per your case, I think it is a eligible credit under 16(2). And but exactly, can you please elaborate and write what is the issue? If that is a genuine, is the proper officer is denying the credit, or is there any other issue? Can you please elaborate on this, please? But as far as the limited facts are concerned, I think where we have a genuine ITC and we can provide the evidence of actual supply, the credit is allowable. Chartered accountant using car for meeting client, traveling for audit, attending assessment, etc. Basically professional in nature and not personal purpose. Whether GST input can be claimed on motor vehicle ITC or motor vehicle ITC ineligible as per section 17. If that is a specific case in 17(5), the any passenger vehicle having less seating capacity of below 13 passengers, the credit is ineligible. So even if a car is bought by a chartered accountant for his professional business and for his professional work, the restriction will still stand. And in my view, we cannot claim the credit of the car. Next, we have product is taxable at 5%, some processing is done. Tax percentage of product unchanged, but processing charge tax at 18%. Can I take the input of 18% processing charge full? If no, you can tell me the apportionment is a 5% paper purchased from dealer of and 5%. It was the paper clean with the job which charge 18%. I should paper. Can I clear? Yes, for the service charge, sir, in your case, I think the credit is allowable. Since it is a job work charges, you can take the credit, and the notification does not stipulate any restriction for the present rate of tax. Issue tax invoice for the service to be provided for 1 year, whether recipient can avail ITC in full now. So, exactly, sir. If the service has to be provided for a complete year, you mean to say that there is the receipt of services will be in 12 parts. What I can understand from your question. So, in my view, when the service is being received in 12 parts or on a monthly basis or a continuous basis, you are getting the complete invoice at the inception. I think the obligation of the supplier and the recipient gets discharged. It is only the delivery of service which takes place afterwards. So, receipt of services and delivery of services, there is a distinction, sir. I think in this case, you have received the services at the time when you have made the payment for the services and you have entered into a contract. Now, the delivery of services will be done at certain point of time in future. So I think once we enter into a service contract, once we make the payment, full credit is allowable. Only thing is the delivery will be as per the terms of the contract, and the delivery is dependent on a future period and is split as and when it is required. So, in my view, on the date of invoice, we can claim full credit and only delivery is being deferred. Where to get more in? Can you say any deep dive courses? Sir, the deep dive course is definitely a litigation management certificate course, which is uh, which is being held by the indirect tax committee of our ICI. I think that is a 6 day course, and you can enroll yourself in
Sorry to
that.
interrupt. It's not a certificate course, but it's a 6 days workshop on litigation dispute mechanism,
Management.
GST
Okay.
dispute mechanism, and various
Okay.
branches are conducting it jointly with GST committee.
Okay. So that is a 6 days workshop that you can join on litigation management that is being conducted by our ITT committee, as told by Impreet. Whether ITC pertains to LUT export service and SEZ supply can be claimed against taxable interest is mandatory refundable. Sir, in my view, yes, you can claim the ITC where the ITC of goods or services you are claiming has been exported or supplied to SEZ. Instead of claiming the refund, you can utilize that ITC with the supplies you make indigenously, whether they are interstate or intrastate. So there is no mandatory provision under law to only go for refund if you have mixed supplies of export and supply to SEZ, and further you are also doing supplies interstate and intrastate. You can use the credit of export supplies at the ITC of goods or services used in making export supplies or supplies to SEZ towards the indigenous supplies also. There's no mandatory requirement to apply for refund of ITC. Next, in the case where an assessee exports goods or services under LUT, whether payment of IGST and files a refund claim, there are multiple payments received against a singular export invoice. Which date will be considered as a relevant date for determining the time limit for filing a refund? claim under GST, the date of receipt of the first payment or the date of the last payment. Sir, in this case, the relevant date will be the date of export, where the payments are received in parts. So, wherever the exports are done, you have generated, you have obtained the shipping bill in that respect. That will be the date of export. As far as the payment part is concerned, payment can be received by us in few installments. That is one of the condition of export of goods or services. But ultimately, the payment will not determine your export date. The export date will be determined with your shipping bill date only. RCM paid at the time of assessment along with interest, whether ITC can be claimed. Sir, where RCM is paid at the time of assessment under section 65 in 25-26, we need to first find out whether the RCM, can you just elaborate whether the RCM is on account of a registered supplier or an unregistered supplier? Can you just elaborate to enable me to give a clear answer to this? Next, if a capital assets is bought by the proprietor firm, whether an ITC is ineligible for claim, GST and cess on car purchase, should the proprietor firm reverse the L3B? Please elaborate and explain. Thanks. Sir, if any car or a passenger vehicle is bought, you are running a proprietary business, you cannot claim the credit since it is a passenger vehicle having a seating capacity less than 13 passengers. Where there is a commercial vehicle used in your business, you can claim the credit. Where it is a passenger vehicle, you cannot claim the business even if it is purchased for the proprietorship concern. Dealer has received a free tour from a manufacturer. Value of this incentive is rupees 2 lakhs as per form 26 AS. Whether dealer is required to raise a bill on manufacturer for 2 lakhs and how much GST will be charged, whether the manufacturer will get ITC for the same. So, exactly, if it is a free tour, what we can understand, they are deducting the TDS and giving it in the form of incentive. So, if that is a dealer incentive, an invoice has to be raised for the value of incentive received in kind, and GST has to be paid on that. And section 17.5 bars gifts. Section 17.5 does not bar incentives. So in my view, raising an invoice, you can claim the credit also. ITC of civil work pertaining to installation of AC, fans, furniture on rented office premises by a tenant can be claimed or not. In my view, these are on a rented premises. If you are treating this as a revenue expenditure, debiting in your profit and loss, all the repair, maintenance, installation work, fan, furniture used for your office premises, I think there is no bar and ITC can be claimed on this. Import IGST of ITC of IGST is not appearing in 2A, 2B, but bill of entry is available. Can ITC be claimed because GST department is issuing notice? In import cases, 100% you can claim the ITC. When maybe at a lower level, the department is disallowing the credit, but once you produce the bill of entry and there is there has been certain time when the bill of entries are on a back end auto link with the GST portal. They ought to come automatically on the GSTR 2A and 2B. If that is not coming, it is a portal glitch, and I think you will get the benefit of on the basis of bill of entry and ITC. In my view, ITC can be claimed. The department is issuing notices, the issue can be contested on merits, and I think you will 100% get a relief on that. Whether Rule 37 ITC 180 days condition is applicable on RCM input, the answer is no, it is not applicable on the RCM input. Trading firm dealing in exempted products and submitting GST returns regularly, it's having ITC on a rent paid showing the same in the electronic credit ledger too. Can it be claimed refund? The answer is no. A trading firm which is dealing in exempted goods, ITC paid on rent, no refund, not permissible. Okay. How to treat this credit then? Sir, actually, if the exempted, if a trading firm is dealing in exclusive exempted goods, whatever ITC is flowing in on raw materials and services, it is a part of cost. Please claim the credit in 4A5, do a permanent reversal in table 4B, 1 of 3B. And in the books of accounts, consider as your cost debit in the indirect expenses. No claiming of ITC permissible where only exempted goods are being dealt with. Vendor is paid as per the payment milestone 60, 30, 10 on different time. That is beyond whether ITC will not paid in 180 days. If the vendor is paid as per the payment milestone 60%, 30%, 10%, whatever portion of payment is beyond 180 days, we need to proportionately reverse the ITC. If the creditors are written back, since no more payable, will ITC credit need to be reversed on the same? I think if the creditors pertain to GST regime and they are being written back, ITC reversal is required under second proviso to section 16(2). If the creditors are of pre-GST regime and they are now being written back, no reversal is required. GST department issues notice under section 74 instead of section 73 for wrong claiming of ITC due to the time limit for issuing the notices, but invoice for ITC available. How to handle such situation? Sir, in my view, if the department for wrong claiming or mismatch of ITC, it is issuing notices under section 74, the notices is not sustainable. If we can contest it, please contest it on the basis of available documents and records with you. You can also, if the litigation is for the first 3 years, I'm very sure that you will be successful in getting the show cause converted from section 74 to 73 at either the first appeal or the second appeal level. And also, please uh, be sure that once you are successfully fighting the appeal and SCN gets converted from 74 to 73, you can file MNST scheme, claim the benefit of MNST scheme if at all some demand is there after all the relief we got. Some recipients like PSU will recover security deposit LD while processing the invoice. In such cases, whether ITC to be reversed even if recovery is permanent. Further, if security deposit is refundable, should we reverse the ITC? In my view, you are the supply. You are talking from the viewpoint of the supplier and not. So if there is some recovery like LD, etc., from the invoice, there is some deficiency in goods or there is some deficiency in the services. I think it is not the case for ITC reversal will or will not take place at the end of the will or will not take place at the end of PSU. So far as you as a supplier is concerned, I think for deficiency or goods and services, you need to raise a credit note for that. The new provisions basis CGST Act treatment of post-sale discount credit notes. Section 15(3), Circular 212. GST invoice is not required for post-sale discounts. However, if the credit notes are to be given to the customers for the selling price reduction, please confirm if this provision applies. The credit notes in relation to selling price adjustments should be GST invoice, in my opinion. Sir, in my view, Section 15(3) and Circular 212, where there is a post sale discount, Circular 212 asks us that please ensure that whether the recipient has reversed the credit or not. Take the certificate from the recipient or his chartered accountant. This is what Circular 212 states. Now, in our case, credit notes are to be given to the customers for selling price reduction. So, we can very well give credit notes for selling price reduction on a post sale discount basis, provided we do the compliance of Circular 212 and obtain the vendor declaration that in GSTR 3B the credit has been reversed. In my view, credit note should be issued as a GST credit note. Along with the compliance of Circular 212, we can take the certificate from the recipient or his CA depending on the quantum. Thank you, sir. I'll share my PPT. Thank you so much. Sir, I think the safe vault, another issue is, can a safe vault where safety lockers are kept in a bank be considered as plant and machinery? The safe vault has reinforced concrete walls and safe vault steel doors with burglar alarms and access control devices. Therefore, can ITC be claimed on construction of safe vaults? Sir, to the limited facts that we have, in my view, safe vault has a functional utility and they can be considered as a plant and machinery. In my view, installation of safe vaults is an installation of plant and machinery for a bank, and in my view, credit can be taken. Safari Retreat's main crux. Safari Retreat's main crux is apply functionality test. Once we apply the functionality test, we determine whether a structure is a plant and machinery or it is a building. If that is a plant and machinery, it is covered by the exceptions of 17.5D, the exclusion of 17.5D. We can claim the credit. If the structure qualifies as a building or a immovable property or a civil structure, it does not qualify as a plant and machinery, and therefore it is hit by the provisions of section 17.5D. Is interest or penalty for fake ITC be reduced or waived off? No, in my view. No, sir, it is not waived off or reduced. Whether we can take ITC on lifts installed in building constructed for renting services, there has been a judgment of cone elevators in the erstwhile regime which allowed the credit, but specifically there are certain advanced ruling in the GST regime which have denied the credit on lifts. So please be a bit careful while taking the ITC. We can have justifiable grounds as why a lift should be treated as a plant and machinery. We have both the sides of this, and I think if we can substantiate it that it is a plant and machinery, we can claim it. But this issue is a bit litigative. So plan and take a tax position very carefully. 122 1A, sir, is dependent on a person who abets committing of a offense under the provisions of a statute. Any person who is assisting somebody to commit an offense is also a offender, and 122 1A imposes a penalty even on the person who helps the other person to commit the offense. So 122 1 is a specific provision for person who is assisting or abetting and helping somebody to commit the offense under the provisions of GST law. Mismatch of 1 and 3B, sir. Normally a mismatch on 1 and 3B, how to respond? In my view, we can prepare a proper reconciliation of this, and once a proper reconciliation is submitted, we have reasons why there was a mismatch, and we can explain it to the department. I think the case will be coming in your favor. Can we take ITC of the gypsum partitions made in the building constructed for leasing purpose? Sir, I think ITC on gypsum partitions, if that is that is something which is not a part of a building and it is only an internal partition to a civil structure, I think ITC can be allowed, can be taken on that. Kindly clarify whether we can take credit on repair and renovation of building used for production. Absolutely, sir. We can take the credit. Whether we can take the ITC of hotel bill when we are in the business of event management. Yes, you can take the ITC of the hotel bill. Just check the place of supply provisions for that. ITC for construction hotel building, in my view, it is not allowed. A restaurant, does a restaurant allowed to take ITC? Restaurant is only allowed when the restaurant is located inside the specified premises, and a specified premises has been defined under the law to have rooms and restaurant. Where there are rooms having a tariff above 7,500, in that premises if a restaurant is located, they have to charge the output tax at 18% and they can claim the credit. Else, any restaurant not located in a specified premises is not allowed to take the credit. Can we claim the ITC on service and maintenance or car? No, sir, I don't think so. We can claim it on a car since the as credit of asset is not allowed. Its service and maintenance and insurance credit is also not allowed. How should a registered person report rental income from a resident received from a sir? Considering this is exempt income, we can show it under the exempted income in GSTR 1 and 3B. There are specific columns. We can report the income there. ITC of exported goods allowed to utilize against GST liability of taxable supply within India, absolutely allowed, sir. If we are having any input related to export of goods or supply to SEZ, we are free to utilize that credit against our indigenous supply made within the India. It can be intrastate or interstate. That is 100% permissible. We need not compulsorily go for refund. That can be absolutely utilized. Shop is located in a shopping complex. Whether ITC can be taken on monthly shop maintenance paid to association registered with the RWA? I think, sir, you can claim the ITC on this. Does restaurant allowed to take ITC? I have already answered on a restaurant. If that is in the specified premises, you can claim ITC. If restaurant is not located in the specified premises, we cannot take the credit. In the case of GST, RCM to pay on raw cotton purchases, but the assessee not paid cash on purchase, but he paid cash on supply. There is a demand for GST RCM cash. How to justify revenue product and GST appeal? Okay. So, in case of RCM, sir, there are erstwhile judgments. I'll share with you if required. There are erstwhile judgments of high courts where, on the basis of revenue neutrality, the uh, case have been decided in favor of the taxpayer. So you can take the ground of revenue neutrality. Ki have I paid the tax on RCM? I would have been eligible to claim the credit also. If I have not paid the tax, I am not taking the credit also. So, on the basis of principles of revenue neutrality, you can contest the case by relying on the judgments in this behalf in the previous stay regime. ITC reversed under Table 4B2. Can it be reclaimed after 30th November of the next financial year as per Rule 37? Absolutely, sir. You can reclaim because 4B2 is a temporary reversal, not a permanent reversal. There is no time limit to reclaim, so you can claim even after 30th November. So, uh, I have dealt with all the issues and the questions raised by our members on the chat box and would now like to express my gratitude to the IDT committee, to the chairman sir, vice chairman sir, uh, secretary madam, Ajay ji, Impreet madam, and the entire team who has made so much efforts to organize this. And I thank to all the team, to the entire team for giving me this opportunity. And if any other issues remains, I'll be available to deal with that separately. And now I would like to hand over the session to the organizers.
Thank you, sir. Thank you for wonderful session.
Thank you, ma'am.
Hello. Hello. Thank
Thank
you
you,
for
ma'am.
wonderful
Thank you.
session, sir.
Thank you, ma'am. Thank you. Thank you, everyone.
Bhargav sir, we can sign off the